Every candle on a chart might appear straightforward. It's either green or red, moving up or down. However, contained within that single candle is a rich narrative of price movement. This intricate story often goes unnoticed. Today, we're diving deep into the essence of candlesticks. We'll uncover how they're calculated and why two similar candles might convey different meanings. Stay with us, as the final detail explains how candles can mislead us. A candlestick isn't about predictions or opinions. It captures a summary of price action. Each candlestick contains 4 essential figures: open, high, low, and close. This set is referred to as OHLC data. One candle represents one time frame, whether that's a minute, hour, or day. That's all there is to it. Now, let's dissect a single candle's components. At the onset of a new time period, the first price is the open. As trading unfolds, prices shift. The peak price recorded is called the high, while the lowest price becomes the low. When the time period concludes, the final traded price is the close. That's the essence of it. A candle embodies everything from that specific interval. Yet, here's a crucial detail: identical price data can yield entirely different candles based on the timeframes applied. Take, for instance, a 1-minute candle versus a 1-hour candle. They tell vastly different stories. Why? It's because of their diverse data groupings. An hour-long candle condenses 61-minute narratives into one. The same trades and prices can lead to different interpretations. Candles don't alter reality, they shift our perception of it. Now, let's clarify another common misunderstanding. Candles have colors primarily for comparison. If the close exceeds the open, the candle turns green. If the close is beneath the open, it appears red. That's the meaning of color. It doesn't indicate strength or significance. It simply shows where the price ended concerning its starting point. Two candles with the same color can narrate completely different tales. Here's an essential aspect often missed. Candles can obscure information. They don't reveal the speed of price movements or the frequency of reversals. They condense complex details, which strips away vital context. Candlesticks don't aim to predict the future. Instead, they clarify the past in an efficient manner. They transform countless price movements into an easily digestible format. So, the next time you glance at a candle, recall that you're viewing a summary, rather than the entire story. In our previous video, we covered TradingView's data pipeline. In the upcoming video, we'll investigate how indicators are formed from candle data and why they sometimes present conflicting information. Don't miss out. Thanks for watching Think How, When, Where and Why. If you want to understand the technologies reshaping our world, subscribe.